Hey guys, this is Andrew for TRENDLINES.com. I've been working as a professional trader for the past 6 years in Hong Kong, and right now I'm doing YouTube videos because I want to pass the knowledge, guys. I want to show you how pro traders are actually working and how we do our analysis. So in today's video, I want to answer a very interesting question, guys, that I'm pretty sure you all have. Are we in a bubble? Is the equity market right now in a bubble, and is it going to collapse soon? So to answer that question, I'm going to try to use all the different tools that I have and actually give you my view, and you're going to be pretty shocked to see what I'm going to tell you. Let's get into it. So first thing, let's have a look on the S&P 500. I'm on a monthly time frame. Basically, this is just, since the 1929 crisis, is just going much higher. But I'm on a logarithmic scale, guys, very important when you look at long-term price action. And you just can see the first thing is that, yes, you can feel that we are in a bubble because look at the price action took 75% in a matter of months. But I'm sorry, guys, if you just, look at this and compare to what we had, for the past 100 years, I don't see anything too crazy, all right? So I'm going to come back to this and I'm going to do a very deep analysis and give you my answer to tell you guys if yes or not we are in a bubble. First, I selected some articles that I found interesting. So I'm on Seeking Alpha. Guys, this is free. You just give your email address to this website and you can access all their very interesting articles. What I can find here, I want to discuss a few stuff. So first, in response to the figures, so the figures are the big equity inflows that we saw on the 10th of Feb. So Bank of America warned that policy stimulus continues to flow to Wall Street assets, not Main Street. What does it mean, guys? It means that all this money printing that we are seeing for the past year, and actually it started in 2008, guys. Very quickly, this is the Fed balance sheet. So you can access this, St. Louis Fed, it's public data, and you can see the Fed balance sheet is how much money they actually created, fake money. And in 2008 they started to print, so they printed 1,000 billion, 2,000 billion, and now in the during the COVID crisis they went from 4,000 billion to now 7.6, and it's still increasing. So this money is actually not going to the real economy as it's supposed to do, all right? Otherwise we would have inflation. The inflation is not there yet. They are actually fighting to get the inflation around 2%. But right now it's around, I think, 1.5 on the quarterly adjustment, but it should be much more when we see all the money that we print. Very quickly, guys, if you print money, you increase the total amount of currency, and the total amount of value that goes against this currency is still the same. So for example, for $1, you should have less value because now you have $2 for the same value. So basically this is called inflation. And we don't see it. Why? Because this money is going to the assets, all right? Equity bond market. So this is the first sign for me of actually something that is not healthy. This is creating more inequality, inciting historic wealth, inequality via asset bubbles. So this is a sign of a bubble. I'm not saying that we are in a bubble. I mean, actually we are, but let me, give you my answer step by step. But I don't think the bubble is ready to burst for sure, but it's just creating some tensions. So this wealth inequality that is getting increased when it's actually supposed to help the real economy, it's not. So this is not healthy for the market, and this is a sign of a bubble. Then we have Cathie Wood. So Cathie Wood is actually the CEO of ARK Investment Management, and she's giving her view. She's saying there is no bubble in stocks, and she's fully invested, in a lot of stocks, and she's saying that there is no bubble. But for her, we actually have another issue. She's seeing a bubble in the bond market. So she says, if anything, it's fixed income that is in a bubble, all right? And squeeze rallies in GameStop and AMC that you guys saw. I've done a lot of videos about it, and you saw, guys, the insane increase in the price action in just a matter of few days. So this is another sign of a bubble. But she's saying that this is inflating actually that bubble, the fixed income bubble, because it allows those companies to raise more capital without any change in the business model. That's true, guys. I did a video on AMC last week, and I was showing you guys what they did during the rally. They actually emitted more shares. So they raised money through equity. And look, they raised money through equity, but still the bond market So this is still Kathy Wood saying that, you know, she's still here, ARK Invests Wood, talking about what is happening on AMC. She's saying that we saw the bonds selling at 5 cents before this crazy price increase, and then they have moved up to 80 cents, guys, times 16. And why have they done that? The move up in the stock gave AMC the opportunity to do an equity offering. That's what I just said. They raised money through equity, but they're also raising money through debt. They don't need it, you know? So this is a sign of a bubble. Why would they actually sell bonds, AMC, when they actually can raise money through equity with the stock going higher? So the question is, who will be left holding the bag if AMC goes bankrupt, all right? People who invest in the stocks are going to lose money, but people who invest in the bonds as well. So we need to be very careful and to keep an eye on what is happening here. And another interesting thing that I want to show you guys. So here, Sam, a very interesting article. I'm not going to go through all of this, but basically they are trying to tell you how bubbles are working, irrational exuberance and the makings of a bubble. And what I think interesting here is talking about bubble. They say they are runaway trends, unstoppable, that misallocate capital. Guys, what we've seen that the money that is supposed to go to the real economy is going to the assets, the equity and the bond markets. We've seen that companies like AMC, they can raise money through equity, but weirdly, and we don't understand why, the bond market is also increasing a lot. So it makes the rate going lower, even if the business model is not changed. So this is a capital misallocation, a nice example, and reshape the investment industry. This is as well what is happening, guys. You know, the people who invest the money are investing it not based on fundamentals. They just put it in what is hot, as I've shown you guys in a lot of my videos. And as I mean, you don't need me to see that. You can feel it, guys. And so many people starting to get interested in the stock market, and they don't put their money where it should. I mean, nobody knows where the money should go, but definitely not in the companies that lose money. And he concludes saying that, talking about these bubbles, that they end careers. So this is, you know, some bad stuff that is happening when those bubbles burst. We not having this yet for sure. They take some stopping. So the thing is, it's very hard to correctly identify a bubble situation and extremely hard to time on. The realization usually comes after the fact. Guys, this is where I actually come into the game, and I'm going to use my tools and I'm going to show you why I think that we are not in a bubble yet, that the bubble is coming, and I'm going to try to give you some targets. So this is now the technical analysis part. This is the S&P 500 since 1929. So as you can see, guys, so I'm on a logarithmic scale, very important. So as you can see, guys, this market is just going higher. For those who have watched my previous videos, I like to use Elliott wave principle because it gives you a lot of information about the market, because the market is actually developing in waves. Each wave has a meaning. For those who are interested to know more about that, just click on the link in the description of the video, and you're going to receive a free video where I explain in details all these mechanisms, and I'm going to show you some practical examples. But here I can also give you some nice practical examples. I'm going to try to identify the 5 waves up. So 1, 2, 3, 4, 5. 2 and 4 are corrective. So here, where do you see corrections? So this is one cycle for sure. After the 1929 crisis, we have one big cycle that is going to develop in 5 waves, as it usually does. So we try first to identify correction phases. Here we have one. Okay, definitely. So 1, 2. This is a 2 because here it's corrective and here is corrective. So basically this is a 2, this is a 4. So this is giving me already this. So 1, 2, 3, 4. And we are in a 5. So just very quickly, the 5, I would put it here somewhere, you know. You can put it here, but then the 5 looks short compared to 1 and 3, right? The 5 might go maybe here. So we are here on the S&P 500. So just visually, it can go to 7,000 within like a few years. It wouldn't be something crazy compared to what we've seen in the past century. Then, now that we have that, I'm going to go back on the weekly time frame. And I'm going to try to analyze my 5th wave. And same thing, guys. I'm going to try to find 5 waves in this one. So let's start. We try first to find the corrective patterns. So the question that everybody had was this a 5? All right, so we could do something like this: 1, 2, 3, 4, 5. And everybody was saying, you can see, like, you know, a lot of videos about that. Everybody was saying here that, yeah, we just actually completed the fifth of the fifths, and that we're gonna have now the massive correction of this whole move up. But the problem is that if this was the case, we should not actually go above here. We should not have this rally making new all-time highs and, you know, just going crazy at this area. So when this happened, I knew, guys, that the thing were actually different. Here I was neutral. I was bearish here. Actually, I was from those that thought this would be the start of something really bad, but the Fed stepped in the game, and what they did was actually very efficient. And here I was thinking that same thing, the market is going to revert, and that this whole pattern is actually transformed into a new bearish pattern. But what happened is very different. And when actually this, you know, happened here, so basically I identified that here we had an expanding triangle. So this is what I drew here. And what is actually happening, guys, right now is that we broke it on the upside, and we retested it once, twice, and we go higher. So from then on, I knew that this is a 4. You know, triangles usually are in the fourth wave of Elliott wave principle. And after I knew this was a 4, I knew that a 5 is coming, and I know that this counting here is not correct. So now I know that things are like this, guys. Bam. All right. So once again, I don't know where the fifth is going. I don't know yet. But what I'm very convinced right now is that this is going to act as support the whole way up, and it's going to act as support for a few years. So this is giving me a nice exit level if actually, you know, we break it. And this support is actually going higher, guys. So it gives you a very nice exit level that is increasing. And we don't know how far this can go, but definitely, guys, we have not completed this market cycle. So I'm going to keep an eye on this, and I'm going to try to give you some targets based on what is happening. For now, the only thing we can do is use Fib extensions. So as usual, I use Fib extensions. I measure the third wave, and I apply the move to my fourth wave. And the most common levels that usually we are seeing in this kind of development is actually the 1.618 golden number and the 2.618. So this is giving me 5,300 or 7,200. But guys, I want to remind you something, is that the situation is not actually normal. We, I think, are in a bubble. So if we are in a bubble, it's not only going to go to the 1.618, it's probably going to go to the 2.618. And this is giving me my target for the fifth of the fifths. So I think we are going to 7,200. In terms of timing, I'm not sure. I would say, you know, this can be like this if it's a bubble. So maybe, you know, 2023, something like this, 2024, I don't know. So, you know, 1, 2, maximum 3 years, I see the S&P going to 7,000, guys. So take maybe another 80%. Something like this. All right, guys, so that's it for me for now. I just did an analysis on the S&P 500 and tried to show you where we are in terms of development of the waves. I'm not done with the analysis of the bubbles. Next one, I'm going to do the NASDAQ, and I'm going to show you guys actually what indicators you can use to see if we are in a bubble or not. So if you want to know about this next analysis, don't forget to click the sub, like, and bell button so you're going to be the first to know when I upload anything new. And stay close to shore. I see you guys.